In this video we want to talk about portfolio management. Now, as we'll see when we work through the slides, this is just the management of the financial assets of a business or of an individual. And these assets could be property, housing, land, or it could be shares in companies, ordinary shares, preference shares, debentures. It could be investments in government stock. It could be gold. It can be anything which is financial in nature, and therefore, I suppose, capable of becoming liquid, capable of conversion to cash. So I'll go across this again in the coming slides, but that's the idea behind portfolio management. It's getting the balance of the portfolio, this collection of assets, correct. Some of the assets may be doing very well on the stock market, for example. Other assets may not be increasing in price at all, or maybe declining in price. So a portfolio manager will want to look at which ones are doing well, which ones are not doing well, and perhaps makes adjustments. Sell off the ones that are not doing well, buy more of the ones that are performing well. So it's managing financial assets. Let's put some more to this and look at the slides, which really just reproduce what I've just said, but let's look ahead in a little more detail. A portfolio is a method for managing investment. So we know what a portfolio is. It's just a method for managing investment. Portfolio management probably is a better way of expressing that. That's the method for managing investment. A portfolio is just simply a collection of the assets. So it's not truly a method. It's a collection of assets which need to be managed. As I said, housing, land, gold, ordinary shares, debentures, preference shares, local government stock, national government stock, and so on. There are many different types of assets an individual or an organization may hold, and that constitutes the portfolio, which is then managed. And that's the management of that is the method. That needs a method, I should say. It's a collection of an organization's investments, stock, shares, income, capital, funds, budgets, cash, gold, oil paintings, whatever it is. Anything which is financial or is capable of being converted into cash. Portfolio management provides an overview of all investment assets the organization or the individual has acquired. So portfolio management is looking after the portfolio. The portfolio itself is, as I said, the collection of these assets, and it lists out all the assets that the organization or the individual has, and then manages them to try and get the best return on the assets. Portfolio management helps organizations assess financial risk and maximize returns. Well, at least that's the theory. In practice, it's more difficult because we don't know how to maximize returns, generally speaking. A lot of it is almost guesswork. The portfolio manager may have a good track record in predicting the course of the stock exchange. So in that sense the portfolio may gain in value. But there's nothing to say that the financial manager, or the portfolio manager I should say, won't get it wrong. We live in a very uncertain world. There are a lot of risks facing the financial markets. So it's to be hoped that financial management will improve the portfolio, but there's no guarantee. Portfolio managers are responsible for providing guidance and the management of an organization's financial investment. So once they're appointed, a portfolio manager can make recommendations as to what the business should invest in. And here we're talking about resources that are not needed by the business. So the business, let's say, is in a healthy state, it has enough working capital, and it's able to meet its obligations and continue in business. So whatever surpluses it has generated, profits it has generated in the past, these may be put into the portfolio. Now it becomes the province of the portfolio manager, who must look after these assets and try to get the best return, which may mean putting the cash into a high deposit account in the bank, or converting some of the cash into shares in a particular company, or converting some of the cash into gold, whatever. So the portfolio manager has to try and work out what's the best way forward given that collection of assets, given what's in the portfolio. Now, the importance of portfolio management. Well, it provides an outlook on the best investment plan for an organization depending on current financials, depending on what's happening in the markets, depending on the course of the market over the last, or the recent history, I should say, over the last few weeks perhaps. So it's looking at what's the best investment plan, trying to work out what that is. And as I said earlier, it's a little like crystal ball gazing. It's not a precise science. There is a lot of risk involved. There is a lot of uncertainty involved. And there's no guarantee that the course of action will yield particular outcomes. So it's very much a question mark as to what the best course of action is. Nonetheless, portfolio managers are brought on board just to take those decisions, to look after the portfolio, to try to get the best return on the portfolio. Portfolio management helps to reduce the chance of loss and risk regarding investment decision making. Well, again, that's the theory. In practice, it may be the case that the markets turn very quickly and there are sudden losses because markets crash or particular companies experience sudden problems which could wipe out their share prices. So the management of a portfolio is it is speculative in some senses of the word. It is speculative. They are hoping to get the best return, but there is no guarantee that they will. Portfolio managers are able to assess individual client needs and devise a policy which will yield the highest profitability. Again, in theory, that's what to do. They try to work out what the client's needs are, when they will need to draw on the portfolio, perhaps because of foreseeing something in the future that they need to do. So they will want to draw on the portfolio. So they may communicate this to the portfolio manager. But the portfolio manager then goes on to try and get the best return. But as I said, it is very much hit and miss. There's no guarantee. The financial markets may go up, go down, and this may happen suddenly, and even the best portfolio manager will be surprised at the way in which the markets have moved. A sudden piece of news from the government over some issue may have an impact on financial markets. Something may happen overseas and it will have an impact on the financial markets. And there's no way of foreseeing this, so it is hit and miss. Types of portfolio management services. Well, active portfolio management. Portfolio managers are actively involved in buying and selling to ensure maximum profits. I keep saying maximum profits. It's what the literature states a lot. But in economics, which there are many models in economics based on this idea of profit maximization, economists have long moved away from the idea that this was a credible objective of companies. Maximizing profits is a very vague term. Does it mean simply making a lot of profit? Well, it's to be assumed that every portfolio manager will set out to make a lot of profit. But how to do that is the problem. There are so many unforeseen circumstances waiting to surprise the portfolio manager. As I said earlier, it could be just a piece of news coming from a country overseas that suddenly affects the stock market and causes share prices to fall, and hence the value of the portfolio to fall. Well, that could not have been foreseen. It was a total surprise, let's say. So there's an active portfolio management style, however, in which the portfolio managers are actively involved in buying and selling and trying to make the most they can. That's what we mean by active. The portfolio manager is working on the assets, trying to improve their value. There's also a passive portfolio management, which of course is the opposite. It's the management of a fixed portfolio for a given market. And there may not be a lot of buying and selling in terms of the portfolio. The assets in the portfolio are purchased once and they're left there, in a sense left there to mature. Hopefully they won't lose value, but it's passive. The portfolio manager is not actively buying and selling, perhaps on a daily basis, perhaps monitoring the portfolio from time to time, talking to the owners, and then making some adjustments, maybe modest adjustments. The types of portfolio management services, well, there's discretionary portfolio management. The portfolio managers are given the authority to manage all financial needs. That's discretionary. They have discretion over the portfolio. The managers are able to buy and sell as they see fit. They manage investments, paperwork, documents, policy, and take decisions on behalf of the organization or on behalf of the individual, depending on who owns the portfolio. So they have discretion. They're able to buy and sell and be involved with the management of the portfolio in a very active sense. They're able to, on a day-to-day, buy, sell, adjust the portfolio, have more of one type of asset and less of another, and sell shares in that company, buy shares in a different company, sell government stock, buy debentures in a certain company. So they're able to mix it up a lot more. They have discretion over it. And of course then there's non-discretionary portfolio management. The client takes full control of decision. The portfolio manager, I should say, provides advice and takes on a consultancy role. So it's non-discretionary. The portfolio manager in this case just offers advice. It's similar to being a financial consultant. Just offers advice about the portfolio, makes recommendations as to what perhaps should be done, which assets should be disposed of, where the proceeds from that should be reinvested, and just making recommendations. So there are two types of portfolio management: discretionary and non-discretionary. Now this has been a short video just on the topic of portfolio management, just to give a flavour of what it's about. But that's all we're going to deal with in this video, so let's leave it at that and say thank you for watching.